And for more on China's economy and what the GDP data reveals, we're joined by Leland Miller, president of the China Beige Book International. Leland, great to have you back on the show.
Thank you.
So Leland, we've got GDP of 7.5%. Some are saying this is proof that a hard landing has been averted. Others saying way too soon to tell. What's your outlook?
Well, it's clearly too soon to tell. The question is whether the GDP number makes any sense. I mean, we've seen a quarter of slowdown, even in the official numbers. China Beige Book numbers were much, much weaker. We saw broad deceleration across the entire economy. We only had two sectors that stayed the same. Everything else had gone down from Q1 to Q2. So whatever the government is announcing as a GDP figure, it's not reflecting how firms on the ground are doing.
Well, you would know how firms on the ground are doing because China Beige Book International surveys over 2,200 companies across China. What are your surveys telling you? What do the businesses and companies on the ground feel about the economy?
Well, you know, they're sitting this one out. And this is very interesting because everyone thinks that a positive outcome is for China to have a higher GDP number. That's actually not it. What you want to see is the rebalancing that the leadership promised. And the rebalancing is only done if investment spending goes down far more than consumer spending. And we saw that in our data. This quarter, firms weakened CapEx growth considerably. And loan demand. So firms were basically sitting out during the uncertainty, watching the slowdown and not borrowing or spending this quarter. And that's a good thing.
The government put in place a mini stimulus package to get to that 7.5% number, according to the government data. Do you see that continuing?
Well, you hope that they won't. It's sort of the tried and true method when the leadership gets a little bit scared about the economic numbers, you do stimulus. Stimulus is different than it was previously.
But this was a very targeted stimulus.
Well, the question is how targeted can you make stimulus? I mean, you could say that you're only attacking small businesses and funding them or agriculture, but it's really hard to mechanically plug holes in the economy. What they need to do is let businesses fail, stop misallocating capital, and let the economy slow down and restructure in a healthy way.
Slow down to what rate?
Well, you know, again, the GDP number, who knows what it actually is? It's probably not 7.5, but it's more important to look at directionality. What you want to see is you want to see the low-margin economy turn into a high-margin economy. You want to see sectors like retail and services do better, and manufacturing not so much. And you want to see the property sector stop being so much of a precipitator of growth.
Well, the property sector has been cited as one of the big concerns by economists, including those at Bank of America Merrill Lynch. They're saying that a hard landing cannot be ruled out because of strong headwinds as a consequence of the property downturn and of the anti-corruption campaign. Are both of these issues major concerns in your opinion?
Absolutely. This is the problem with trying to plug holes. You're going to try to manage a property slowdown. You know, you have a bubble. You're trying to manage it in a way that won't cause too much outrage among people, among homeowners. But you're trying to deal with shadow banking. You're trying to deal with all these other problems. You can't deal with all of them without feeling some pain. And what the Chinese leadership needs to understand is this is going to be a painful transition. They can do it, but they need to understand that they're not going to be able to keep things at 7.5% GDP or even close.
One of the premises for China's reshaping of its economy has been the focus on domestic demand. Are we seeing that the data supports this? Are consumers stepping up?
They are. Now, we saw a drop in retail spending this quarter, but it wasn't as precipitous as the drop in investment spending. That's a good thing. That's rebalancing. So what's interesting is a lot of people think the China growth story is bullish if they see higher rates of growth. But again, what you want to see is slower growth, healthier growth. That's what China Beige Book saw this quarter. So I would say that the China Beige Book growth story is a much more bullish picture of China than what the official data is saying.
So it's a slower picture, but it's a healthier picture.
That's right. And that's what China needs to be going forward.
So what reforms do you think that we can expect the government to implement, and what reforms should they be implementing?
Well, the first thing is deposit insurance. This should have gone in a long time ago. They need to start fixing this. Everyone talks about liberalization of interest rates and about of the currency. These are steps that are going to take some time, but there needs to be continued movement in that direction, and they need to, first and foremost, let firms fail. They need to see defaults.
All right, we've got to have some collapse in the economy for the others. You've got to burn down the grass for the sprouts to grow green. What would you say is the biggest bright spot in China's economy right now?
Well, I'd say that there is rebalancing going on. I mean, the fact that things are slowing down, again, is not a negative if it's the right kind of slowdown. And we saw evidence in this quarter's data that the right kind of slowdown is happening. We're seeing some rebalancing.
Okay, slow and steady wins the race. Thank you so much, Leland Miller, president of China Beige Book International.